Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent jobs report. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Link is in the description below. So, the first week of every month is fairly eventful in the sense that we tend to get a lot of labor market data to take a look at. The reason why this is useful is because when the labor market moves, it does tend to have an effect on markets. So it's worthwhile to note if it's moving or if it's still relatively stagnant. So the first thing I will start with is that the unemployment rate came in lower than expected. So the consensus view for the unemployment rate this month was 3.9%, but it actually came in at 3.7%. It is noisy on some of these monthly timeframes, so I do find it useful, generally speaking, to apply, say, like a 3-month moving average to it. It helps to sort of slice through some of that noise. So it had been moving off of this 3.5% level, this 3-month moving average low, all the way up to about 3.83%. It's now stalled out here a little bit at around that 3.8% level when looking at it on a 3-month basis. So we'll continue to follow the unemployment rate and see if it continues moving higher or not in the coming months. I think a lot of it will depend on, again, on whether the Fed funds rate of 5.5% is sufficiently restrictive or not. We can also look at the unemployment. Oh, actually, we could also look at categories. One of the categories that was actually quite high last month has fallen back down some, and that's the unemployment rate for 16 to 19-year-olds. If you look at it, the raw data here, you can see that it has actually fallen back down from around 13.2% down to about 11.4%. If we go take a look at the unemployment level, so we're just looking at the number of unemployed people, you can see that it's currently at around 6.29 million. This is down from 6.51 million that we saw not too long ago. So this chart, shows you that it has been moving higher, although that trend seems to have cooled off in the last month. I do want to take a look, though, at a couple things here with this metric as well as job openings. So if you look at job openings, this report came out earlier in the week, you can see that the trend still remains down in terms of total job openings available. And it's interesting because, over the last few months, there was, speculation by some people wondering if this had already bottomed out around the time that the Fed hit the terminal rate, sort of suggesting that if it had bottomed out, then it might mean that 5.5% is not sufficiently restrictive, or perhaps it's not, and we're just continuing to feel the effects of all the rate hikes. But with the most recent data point on job openings, you can see that it's actually put in a new lower low. So this one over here was at about 8.92 million. It then went all the way back up to 9.5 million. And now it's fallen off to 8.73 million. But there's something interesting we can do with this, okay? So we have job openings, right? We have job openings, and we also have the unemployment level, right? So like the number of people that are unemployed. So one cool thing we can do is we can take job openings and divide it by the unemployment level. Right? So you're basically looking at the total number of job openings per unemployed person. Okay? And when you do that, you get a chart that looks like this. So what's fascinating to me is just how high this went up into early 2022. And the Fed, while it seems like they haven't made a lot of progress with all these rate hikes, you can see that they are making progress, right? The number of job openings per unemployed worker is falling relatively quickly. Now, arguably, the reason why the stock market hasn't cared is because it's still elevated, right? For every unemployed worker, there's still 1.34 job openings. Now, listen, I know whenever I talk about this sort of stuff, people say, well, the data is manipulated, you can't trust it. In my time of investing, going in with that mindset is never really helpful, right? If we always assume that everything we look at is manipulated, you can assume that, but I don't really necessarily think it's going to get you anywhere by assuming that. When we look at this, we can see that there has been an effect on the labor market, and the Fed wants there to be an effect on the labor market, right? The Fed wants the labor market to soften up. The question, of course, is will they start cutting soon enough before this thing goes much further down? You can see that in the last 3 recessions, this thing, I mean, back in the financial crisis, it only ever topped out at 0.737. Over here in 2019, it topped out at 1.23, and unfortunately, we don't have data going back before December of 2001. Not because we don't have the unemployment rate data, we do. It's just that we don't have the job openings data from before that time. So when you look at it, we only unfortunately have it going back to just as that recession was starting. So looking at it like this again is job openings per unemployed worker or unemployed person. It has fallen to 1.34. If you look at the trend, last month it was at 1.47. The month before that, 1.49. The month before that, 1.53, 1.54, 1.58, 1.82, 1.67, right? And all the way back over here in December 2022 was at 1.96. But back in March of 2022, it was at 2.01, meaning for every unemployed person, there were 2 job openings available. Remember, this metric will likely continue going down in the coming months because the trend that we've been witnessing has been job openings has been dropping, right? So job openings has been dropping. So there's not as many job openings as there was previously, but also the unemployment level has been generally going up. But as always, it is a stochastic process, right? Like it doesn't just go up in a straight line as we can see this month. It is a long process. The business cycle takes can take many, many years to play out. And that's why we've often said, back at the beginning of the year, I said that markets will rally until either one of 2 things, either inflation reaccelerates or the labor market finally gives way. I don't think the reacceleration of inflation is as much of an issue right now as it was back at the beginning of the year. Because we have fallen down a lot. Now, that's not to say that it can't go up. It could, and if it starts to turn the corner like it did in the 70s, that will be the next risk to pay attention to. But I would argue that the labor market is more important at this point than inflation. We've seen a lot of energy components come down a lot. And by the way, if you were to go look at inflation, one of the things to look at would be the contributions per category. One of the things you might note, if you break this down by category, is that 2.33% of the overall inflation, because the overall inflation is like a little over 3% headline, most of that is just coming from housing, right? Most of that is coming from housing. If you look at headline inflation, you can see that it's at 3.23%. Most of that is coming from this, housing, because most everything else has fallen down a lot, right? And so I think the bigger risk is that the Fed doesn't cut quickly enough because they're waiting for inflation to actually reach 2%, where you could argue that even if they started to cut early next year, the inflation in the housing market could continue to come down just because of all the lagged effects. Remember, the Fed started cutting in March of 2022, but housing inflation contributions to CPI did not even top out until January of 2023. So you can see just how much of a lagged effect there is. So I think that is the bigger risk is the disinflation, I think is much more likely than us going up to another peak at this time. I mean, I could be wrong about that. If it started to form a base like it did over here in the 70s, then perhaps it would be time to put more weight into that idea. But at this point, I don't really think we should put too much weight into that. As long as the Fed, especially as long as they stay the course as to what they've been doing. So continuing on, I wanted to look at a few other things in terms of the labor market, right? So we looked at the unemployment level. We could go take a look at the unemployment level by reason for unemployment. Job losers continued to go up, right? So that one actually increased from 3.06 million to 3.1 million. Job losers on temporary layoff has continued to go up. If we look at new entrants to the labor force, that one ticked down a little bit. But again, a 3-month moving average shows that it's generally trending higher. Then we can also look at permanent job losers. I believe this one has also continued to sort of slowly increase here, right? So that's by reason for unemployment. We also had this chart, and by the way, you can access these charts through the website. We have some interesting ones, but here's the unemployment rate by state. And it really does depend on where you are in the country as to what the unemployment rate looks like. Like in Florida, it's still relatively low. Like it's only at 2.8%. But then you go take a look at California, and the unemployment rate is at 4.8%. So you can see some parts of the country, the unemployment rate is already moving higher relatively quickly, while in other parts of the country, it hasn't really been moving. To give you another example, in the Northeast, it's not as bad. If you were to go take a look at Connecticut, you can see that the unemployment rate has basically been at 3.5% even to this day. Whereas if you were to go look at, say, the District of Columbia, it's all the way up here at 5%. So it really does depend on where in the country you're located as to what the labor market looks like in that area. And perhaps just to provide a couple more examples just for people that might be interested, here is New York. It is starting to curl up at 4.2%, and Texas might be an interesting one to look at. That one had been moving up, but ever since it got to 4.1% back in May, it has remained unchanged. We could also look at the number of states where the unemployment rate is rising. Now, we're going to fix this chart, I think, to maybe even make it more useful. The way that it's coded up right now is it only looks at where the unemployment rate was last month. But it might be also useful to look at it where it was 3 months ago, 6 months ago. But if you look at it where it was last month compared to where it is today, or the last time it was updated, you can see that 38 of the 50 states have seen the unemployment rate go up from the last couple of months, right? So from 1 month to the other, 38 states saw that go up. We could also include DC and Puerto Rico, and you can see that it actually doesn't make a difference. We could also look at alternative unemployment measures. This is one that is often interesting to look at. Here's percentage of civilian labor force unemployed 15 weeks and over. That one had been moving higher, but it has dropped back down to 1.3%, right? So it bottomed out here at 1.1, then it went all the way up to 1.4. Now it's pulled back to about 1.3. And there's other ways we could look at it. We could look at job losers. This is U2. That one has continued to move up, but this last month it stayed flat. We can also look at the labor force participation rate. I believe that one increased slightly from last month, so from 62.7% to 62.8%. There's the employment level. This is coming out of so looking at total non-farm. You can see that it is still going up, but the pace at which it's going up has been slowing, right? You can see clearly that it's been slowing. And the way to visualize that is to look at a year-over-year percentage change, right? So if you look at the year-over-year percentage change, you can see that when it has gone negative, it has corresponded to recessions. And oftentimes the recession can occur before it goes negative, right? Like in 2001, the recession started when it was at about 1.27% or so. Maybe 0.872, somewhere in that ballpark. In the financial crisis, it started when it hit around 0.892. Back over here in 1990, it started when it hit 1.62. Today, it's at 1.81%, right? So it has been slowly moving down. It topped out, the year-over-year percentage change topped out at 5.2% in February of 2022. And then if we were to go half a year later, let's say August, it was at 4.15, so from 5.2 to 4.15. And then if we go to the following February, it had fallen from a half a year before down to 2.81%. And then from February to August 2023, it fell all the way down to 2.05%. And then from August of 2023 to today, it's now down to 1.81, right? So it is dropping, right? It is dropping. All prior moves to the negative have corresponded to recessions, but you can see that it is not negative. It's not negative. And you can look on you could look at a month over month percentage change to see that the pace at which total non-farm employees has been going up, the pace at which it's been going up has been slowly decreasing. Well, the last few months it hasn't really continued to drop in the way that it was previously. You can smooth it out with, say, like a 7-month moving average if you want, right? And see, over here it was at 0.451%. Today it's at 0.128. You could look at another moving average, let's say like maybe a little bit smaller 5-month moving average, and see that it's down to 0.129%. So still not negative, right? Still not negative. And of course, no guarantee that it goes negative. We can also switch this up and look at total private. This one has been, I mean, again, it is still going up, but the pace at which it's been going up has been slowing down, right? So, I mean, applying a 3-month moving average to this metric shows that it topped out at 0.534%. This is the month over month change back in late 2021. And then in mid 2022, it was at 0.3%. Today, it's at 0.1%, right? So again, the Fed has been successful in cooling the labor market off. It's just that there was a lot of excess, and there still is some excess. Again, for every unemployed worker, there's 1.34 job openings there. So it's not like there are not job openings. It's just that it's been hard to get rid of all that excess in the labor market. We could also go look at non-farm private payroll employment. This is coming from the ADP Research Institute. This one was not as optimistic this past month as what we saw today in the report. But this one, if you look at a year-over-year percentage change, it topped out at around 6%, and currently it's at around 2%, right? So still well above zero, but also trending down. And I mean, you can see it a little bit more clearly with the month-over-month percentage change, and you could apply a 3-month moving average to this and see that, again, it's a stochastic process, but this has been a series of lower highs and lower lows. And most recently, the 3-month moving average of this is the 3-month moving average of the monthly change is at 0.077%. Finally, in this category, we can look at total temporary help services employees. This one is probably the sector of the labor market that looks the most concerning, or one of the things that looks the most concerning. There's definitely areas that don't look that concerning, right? There still seems like there's excess in a lot of areas, but in total temporary help services, if you were to look at a year-over-year percentage change, it is still negative, and it hasn't. It looks like it's just continuing to drop, right? So up here, we had about 3.18 million in temporary help services back in March 2022. Now it's down to about 2.92 million. So it has fallen off a lot. And it's a little bit more concerning than the other metrics, because a lot of the other metrics are still above their pre-pandemic highs, whereas this one is not. I mean, like this one, you can see that before the pandemic, we were at about 3 million, right? And today we're at a little about 3 million as well. So this one, I think, is more concerning than the other metrics, but there are still several metrics that seem like, it's not necessarily too concerning just yet. If we were to look at job quits, so total non-farm job quits, that also has been trending down, but still trending down from a relatively high level. It's currently at 3.63 million. The pre-pandemic high was just at around 3.6 million. So it's basically back to where it was pre-pandemic. We could go look at it in manufacturing and see what's going on there. And you can see that it has been dropping quite a bit in terms of quits. And the reason it would make sense for quits to drop as the labor market softens up is that as the market softens up, there's going to be fewer people that are going to want to quit their job because they might be fearful that they might not be able to find another job. Whereas a couple of years ago, I think more people had confidence that if they quit their job, they could go find a new job. Today, I think while it is still possible to go find a new job, it's not as easy as it was a couple of years ago. And that generally explains why when the economy is slowing down, people quitting their job, it tends to go down, right? And you can look at a year-over-year percentage change and see that it's been negative for a while, right? It's been about negative, between negative 10 to 20%, for basically a year and a half now. And a lot of that, again, is just getting rid of some of the excess. This is the same thing, just looking at the job quits rate. Initial claims still remains relatively low. I think to really be in recession territory, you would need to see this printing in the 300K area. And we got up to 265 last summer, but it still hasn't gone up to 300K. So initial claims still looks relatively muted. Whereas continued claims did come back down some this past month or this past week. It is still trending. A 3-week moving average generally shows that it has been trending higher. So definitely a lot of things in the labor market that we could go on and on about, but I just want to provide a very quick update. I know the markets are moving, and remember, markets love to do this, especially the closer we get, to Fed pivot. Oftentimes, it's around the Fed pivot where things can often change. So just be careful out there. Keep an eye on the labor market. As long as it doesn't loosen up too much, markets love climbing the wall of worry. If the Fed does achieve a soft landing, then you might not see that massive wave of layoffs. Or if there's a hard landing, then of course the layoffs could come very, very quickly. It all depends on how quickly are they able to engineer a soft landing or not. Do they cut interest rates soon enough to sort of take the pressure off of all these businesses? I think the balance is that you still have inflation. If the labor market is still tight, then that's going to provide pressure to wage inflation, which is going to affect CPI. And obviously the Fed's not going to like that. So inflationary periods tend to change the reaction function of the Fed. Under most circumstances, with all these bankruptcies, the Fed would have already pivoted long ago, but they can't really yet because they want to make sure that they get rid of inflation before taking their foot off the gas. So I think that's the biggest dilemma today is, do they cut quickly enough to sort of, to prevent mass layoffs, or do they keep rates higher for longer, too long, and cause a hard landing? And that's what I guess we will find out, sometime the next year. So anyways, if you guys like the content, make sure you subscribe to the channel, give the video a thumbs up. And again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Make sure you check that out. Link is in the description below. I'll see you guys next time. Bye.